Okay, welcome traders to another training session. Now, understanding what has been factored into the market. This is an important part of especially trading the live economic numbers, right? And understanding where the next big move may come from. It's understanding what has been factored into the market. And this is really with regards the macro fundamental data. Okay, and this is why we look at the calendar, and this is why we do have access to the interest rate probabilities. This tells us explicitly what is factored into the market, right? So all the data that comes through the economic calendar, okay, through the course of the month, from one central bank meeting to the next, all of these little components, whether they're top tier data, tier 2, tier 3, tier 4, whatever it may be, these numbers all add up to giving us an idea of what the central bank is going to do. And these numbers here, the interest rate probabilities, this is what we're talking about. This is what's factored into the market. So let's just look at the Federal Reserve. Okay, so the most probable action at their next meeting is a 0.5 percentage point cut. Now that has been factored in 53.9%. Okay, so what does that mean? Well, it means that the market is expecting 0.5%, and say 54% of the market, that's what they're thinking, right? So they've already gone into the market and sold US dollars. So why that's important is because if we now get a top tier number, like an inflation number or an employment number, let me just find a US number here. There's no sort of major top tier numbers coming out in this fourth week of the month. But say, for instance, the consumer confidence numbers. Now, I'm saying we know that 0.5 percentage point cut has been factored into the market, already pre-sold at 54%. So if I'm looking at the forecast here of 104 for the consumer confidence numbers, right? This is where we get the edge. We know that 54%, a 0.5 percentage point. So if these numbers come out extremely strong, 110, that means that 54% this is a good positive number for the US dollar, okay, which would go against a big interest rate cut. So if we get a really strong number here, okay, and above the maximum forecast, well, then the dollars that have already been sold, that have been factored into the market, need to be bought, right? And that'll send the US dollar higher, okay? Now, at the same time, if this number here, 104, is the forecast, okay, once again, and the low end of the range is 101, say, for instance, the consumer confidence numbers come out at 95, okay? Well, in that regard, we already know that 54% of the market are short, okay, expecting 0.5%. This would give the market an even greater chance of a 0.5% cut from the Fed, and that probability would go up, which would mean the market needs to sell more to factor that in. So the dollar goes down. Okay, this will give you a greater understanding what happens, not just if the instrument goes up or down based off the forecast, right? Now that does, like in a general rule, if the number comes out stronger, the dollar goes up. If the number comes out weaker, the dollar goes down. But this is the beauty of it. Understanding what has been factored into the market allows us to manage positions, add to positions. If it's a really exceptional weak number and it's going to create a bigger probability of a 0.5% cut, well, then that's going to send the dollar down a lot more aggressively. So understanding what has been factored into the market not only allows you to trade, but it allows you to gives you deeper information how the market is positioned and what they need to do in relation to the economic numbers that have coming out. If the numbers are super strong, well, then this number here, okay, 53.9% is going to go down, right? And the US dollar will rally. And if the market gets really bent out of shape, and what I mean, like they get, so like, for instance, the RBA here, right? No change. And the 90 sort of, well, close to 94% has been factored into the market that they aren't going to change. So say, for instance, we get a CPI number, okay, which is due out tomorrow, then if that number was exceptionally weak, we would see a massive turnaround here. That may drop by 40%, and that will see a massive sell-off in the Aussie. And why? Because we know that this no change has been factored into the market, and the market will then have to go and correct that by selling Aussie dollars. But the fact is, the no change is 93.9%. That means a huge part of the market has got to sell. And that leads to a much bigger move in the Aussie dollar, right? So the understanding what has been factored in, especially with regards to interest rate probabilities, now it gives you scope to really focus on the economic calendar. You'll be able to look at the tier 1, tier 2, tier 3 numbers, and you'll know exactly how aggressive the reaction is going to be because we know what has been factored into the market. Okay, like the Fed, a 53.9% cut. We've got a Bank of England, a 75.64% cut. That would mean if we got strong numbers, not only would sterling go up, but that would be turned around somewhat, and you would see an explosive move to the top side, right? So understanding what has been factored into the market gives you the edge to be able not only to trade, but to manage positions. Add to the position if it's if you can do that with the numbers, or maybe just trim the position. Okay, so it's very important you understand the concept of what is factored into the market. This is the key part that all the bankers at all these investment banks and hedge funds, that's what they look at. It's all about what is factored in. Okay, so understanding, the forecast and what the actual outcome, that's the first part of the puzzle. But what we want to know is what are all these macro fundamentals, if they're all calculated up and added into the market, how is the market positioned for the next leg of the move, right? And that's very important because when we come back and you start looking at these numbers, then we can start sort of focusing in on technical levels and seeing, you know what, if those numbers not only lead to a sort of small move or a bigger move, we can start to anticipate where the move will happen from the economic numbers and where it may accelerate through trend lines. And that gives you a greater chance of success in these markets, right? It's definitely the one key factor that gives you the edge over other traders and the market itself. And that's why we have the interest rate probabilities available for you to look at the site, right? Now that I've explained that, have a look through the economic calendar, and then you can start to anticipate where the next big move is, okay? And then we can really expand your understanding. If you have any questions, jump in the Discord. I'll be happy to answer more questions about this because it's extremely important you understand the whole concept of what is being factored into the market. All right, traders, have a good one. Cheerio.